Okay, can everybody hear me?
I can.
Casey, can you hear me?
Yep.
Okay.
Yep.
Thank you. Thank you for the problem, the technical difficulties. Looks like that was on my end. I apologize. I think everybody was on hold. So thank you so much. So nobody heard anything I said. That's great. That's fine. We're 5 minutes after, so we're going to go ahead and get this show started. Thank you so much, Casey. Casey's the managing partner with PSK, and he's going to spend some time speaking with us today about navigating the waters of some year-end tax planning on the for-profit business side, as well as some of the tax side on the personal. And I'm going to let him talk a little bit more about his background and where he's come from and what his current role is.
Sure. Yeah. Hey, thanks, Mia. I appreciate it. As Mia had mentioned, I'm the managing partner of PSK, a CPA firm here in Arlington. We partner a lot, and we have a sister relationship with Payroll Partners. So it's a great opportunity, I think, to get together. It's a wild time. Mia, you want to give me control of or do I have control of the slides? It was great hold music, by the way. I think we all enjoyed that. You there, Mia? You want to? There we go.
Now we're cooking. There you go.
Okay.
Now we're cooking, no matter how many times you practice.
Hang in there. All right. It's going to get better, right? Okay. So, again, Casey Campbell with PSK. And so it's a wild ride right now. I think you can see, I hope you can see, history being a predictor. I don't know. But I think you guys can see the boat going down the roaring rapids. It's a wild time right now in the world of tax planning. And we've got sometimes we feel like we're going down the roaring rapids without a paddle. And with the proposed tax law changes, we're not exactly certain where this is going to go. But generally speaking, there are tried and true things you should be doing to help yourself here at year end. And we want to touch base on some of those. We want to talk about some of the business things you can do, current laws that are in place, potentially a few of the proposed laws, and then on the personal side, things to consider. Not all of these will be applicable to everyone. And the overarching theme here, and maybe this is self-serving, is to make sure you are working with a CPA, tax advisor, somebody that you feel comfortable with on making some of these decisions. Some of these will, you need to determine now compared to later after the year end, you would have the luxury of making those decisions. So not all of them have to be here before the end of the weekend, but there are things that you want to make sure you're at least bubbling up and putting on your radar and talking to your advisor. So let's dive in. Now, you'll excuse me, I've got a cough here. I've got an allergy-induced cough. So the 250 coughs that I'm about to issue are free of charge. So no worries there. So President Biden has proposed a 1.75 trillion, and that number has some flux to it, spending plan. And about $1 trillion of those dollars are scheduled to be paid for by higher taxes. So, I could argue and say I'm overly simplifying his proposed plan in 3 bullet points, and that might be quite simplistic. But big picture, we've got a ton of different proposed changes. You got surtaxes on the ultra wealthy above 10 million, tax rate changes at different tax brackets, phase out to certain deductions. There's a lot of things that are happening. But the third bullet point is something to be cognizant of. Under the current administration's plan, the last statistic I saw was they were going to pump 400 billion of the 1.75. I even saw 2 trillion at some news sources they're putting 400 billion into IRS enforcement and raising taxes on some of the business owners. So there's a large push to really increase the enforcement component of the IRS. I'm the first to say, hey, we all have way too much exposure, too much risk, and that's not the kind of business that we do, is to do something that's not right. We all want to do it right, but we also want to be cognizant of the rules, and if there's an opportunity to plan with the rules, we want to make sure we're being efficient through that. So let's jump in. So there's a balance here between your business operations, the tax, and the planning. All those three things have to kind of come into play. So one point I'd like to make mention of is I'm sure many businesses are cognizant of the qualified business income deduction. Well, what is that? That is for flow-through tax entities. So that would be entities other than C corporations. So subchapter S, LLCs, partnerships. These businesses that have income flowing back to their personal tax return, those at the personal tax return level, you are potentially eligible for an additional 20% deduction of that income. So big picture, $100,000 of income is flowing to you personally, you could be eligible for up to $20,000 deduction off of the $100,000 deduction there. So a lot of things go into determining what if you are and what amount you'd be eligible for. And again, that's the thing you'd work with your tax preparer with. But certain businesses, the individuals owning those businesses, if under about a $340,000 threshold, if you have income below that threshold, you would be eligible for that 20% deduction. Some businesses could be well over that income threshold, but a certain type of business, then they would be eligible to take that deduction as well. So what do we do around that? Well, we could salvage some of that deduction by deferring income or accelerating the deduction. So, we just can't say, hey, our hands are off on the steering wheel. Whatever income is income, whatever expense is expense, and that's where it is. Well, tax laws are such that you can recognize income based on certain revenue recognitions, or accelerate income, or if you purchase or you do some leasehold improvements, you can accelerate that deduction and quote unquote manage some of your income legally. And so if you're right on that personal income threshold, you'd want to take a look at that and say, okay, if I go up much more past our 300 some odd thousand, I'm going to be eating into this qualified business income deduction. It's 20%. So if you could maximize some deductions or minimize some income at the tail end of the year to maximize that overall 20%, again, a strategy you could look into. The next bullet point, the small businesses are much more able to use cash tax reporting than in the past. So you're familiar with two different types of books that you would keep. You keep cash basis tax reporting, and then you keep accrual basis tax reporting. So it used to be, not too long ago, if a business had gross income greater than $1 million, and if that was the case over a 3-year period, what you do is you average that $1 million, $3 million divided by 3, and what do you know? That's $1 million. If you're over $1 million, then you have to file on the accrual basis tax reporting. Well, fast forward to now, that $1 million threshold has been bumped up to $26 million. So it's much more liberal. You have much more opportunity to determine how you want to file your taxes. There is a process to convert from one to another. It's not as simple as just saying, hey, I think this year I'm going to do the cash basis reporting. But you could follow a process, but be strategic in your decision making, because if we do elect to file as a cash basis tax reporter, and a lot of businesses are under $26 million in gross receipts, then we have the opportunity to shift that income and expenses more easily than accrual. With accrual, if you have an invoice that you generate out of your company, when that invoice is generated, it's income. Well, sure, you send it over to your customer, and your customer is going to pay. Hopefully, they pay this afternoon, but there's a chance that they pay next week or next month or 2 months from now. Well, in accrual basis, it's income when the invoice is generated. In cash basis, it's income when you receive the cash. So you can see that there's a difference there, a timing difference. Same thing with expenses. You can accrue for expenses, which means you can stack up or total debts that you owe in the near future. It's usually 2.5 months after year end. You can accrue for those debts, and that can be deductible under accrual accounting. Cash basis is kind of like a check register. Where I have deposit. When I make a deposit, it's income. When I write a check, that's a disbursement. So, but with the cash basis, you can delay some of that income recognition. You can accelerate some of those expenses. It gives you a little bit more flexibility. So again, that's another option to look at for businesses under the 26 million, which there's a heck of a lot of them out there. Diving into other things. So currently, there's a very liberalized property expensing for 2021. So that's Section 179 depreciation, bonus depreciation that you can take. So in the past, and it's been like this for a few years, but I think this is a great opportunity for businesses to look to see what kind of needs you're going to have for next year. Am I going to need to enhance my building some? Am I going to want to invest in that new piece of machinery or new leasehold improvements, which would be new flooring and new enhancements again on your building? So in the past, it was a very low threshold which you can accelerate, and I purchased that new piece of machinery today. Oh gosh, I got to expense that out over a 3, 5, 7. If it's an attachment to your building, it's going to be much longer than that. So it takes a long time to recoup that spend. I spent $100,000 now, and I've got to stretch that out over 10 years, so only $10,000 per year. That's a long time to recoup that benefit. Well, in the current tax laws, you can expense right off the bat up to $1 million on investments under $2.6 million. So it's a great opportunity to look into your crystal ball and say, hey, you know what? We're going to need some new equipment. Why not buy that equipment now? Now, I know we got supply chain issues and we got a myriad of other concerns out there, but if we can acquire the equipment now, let's do it now, and we can expense that $100,000 that we purchased this afternoon. We can expense it this afternoon. So it's a great way to drive down that income if at all possible. We'll get to this a little bit more on the personal side, but there might be times where we want to recognize more income this year, and because we think the tea leaves might show that, hey, next year might be a higher tax impact on a taxpayer than this year. So I don't think in every situation, but I think there's going to be some higher income taxpayers that potentially might want to recognize income this year because it's going to be more advantageous, less surtaxes, and we'll dive into that here a little bit. So on the top bullet point, more lucrative accelerated depreciation that's available currently. Make sure you're looking to see what the business needs are. Don't go spend money don't spend $100,000 to get $30,000 in tax benefit. Well, yeah, let's keep the $100,000 in our pocket. So let's don't spend money just for tax purposes. But if we're going to purchase something anyway, why not do it now rather than January? Because we've got potentially a whole nother tax framework to work with under next year compared to this year. So the second bullet point, corporate earnings. On a C corporation, they pay taxes at the corporate level. So I mentioned before, these flow-through qualified business income deduction are available for flow-through entities, subchapter S's, LLCs, partnerships that are taxed at the personal level. Well, C corporations are taxed at the corporate level, and you have to pay. If you're expecting to owe over $500 in tax, the IRS requires you, or you don't have to do it, but they're going to ding you for underpayment of the estimated tax payments. So they want you to pay quarterly estimated tax payments every quarter. So one thought process would be, if you think you're going to maybe have a loss, which if you have a loss, then you're going to the different requirements to calculate estimated tax payments, which would actually be higher based on your actuals that you're paying for. One thought process would be try to recognize a small profit, because then we only have to pay a quarter of that amount each quarter. So quarterly payments based on that much smaller profit that you recognized in the corporation. Not applicable to everybody, but there might be some listeners out there that could be beneficial to. The accrual taxpayer bonus timing. So I mentioned before, for accrual record keeping, we have income when we generate an invoice, and we stick in the mail. It's the income. If we have payments that are due within 2.5 months of the time after year end, we should be accruing for those expenses. So it's expenses to the business and would be income to the individual. Well, if we're a business owner, we can adjust the timing of those bonuses, and we think it's not going to be too punitive next year to recognize that additional income, why not look at calculating the bonus, but then accruing for that more than 2.5 months out, and so you're not going to have to reflect that as additional income to you personally. We're not paying it until after the year end, and so it's an opportunity to shift again some of that income going into the future year. Debt cancellation events. So what is that? So that is if a business knows that they're going to be relieved from a debt that they owe in the future. And so that's great. We don't owe the $100,000 of debt. So for whatever reason, we are released from that debt. Well, that debt then it becomes income to us. So no, we don't have to pay the $100,000, but the $100,000 would be additional income to us. So if you see some of those opportunities out there, if that's applicable to you, your business, look to release those debt cancellations in future years. Because our thought process, what I'm trying to, absent of hard and fast tax laws that we know are what we can take to the bank, quote unquote, for next year and future years, I think you have to take the measured approach and let's be prudent in what we're doing. And overall, we step back and we try to take an approach of we know what tax rates are now. We don't really know what they are in the future. We can have more flexibility in planning for now as compared to the future. I don't know, and I'll spoil some of my conclusion at the end. I don't think the final, once they stop haggling about the final tax regs, I don't know how punitively different they're going to be. There's absolutely going to be some changes. It's going to be more punitive to some tax brackets than others. But I want to make sure that we're not doing things that would be overly anxious and planning for great swings where I think it's going to be less than that. And that's kind of where it falls back into that debt cancellation. Look to defer those events if you do have those into future years. Passive activity losses. So that is my day job is I'm a CPA. So you have a rental property or in your business you have some other passive losses that are generating some income. You have expenses that outstrip the income. And you have these passive losses. Okay, so those passive losses get suspended. So if we, in example, we have 10 grand of income, 12 grand of expenses. Well, that $2,000 loss, that's the passive activity loss in this particular example, and that gets suspended and carried forward year over year over year. So the passive activity losses, whenever, if I'm using an example of a rental property, whenever those properties are sold, then those passive activities losses are unwound or recognized during that time. So let's say we've got a massive income year this year, had a great year. We've been able to navigate a very difficult time in the economy, and not everyone has been able to do that, but you have been able to do that. And you're looking, and in my real estate example, house prices are great, and we're looking to sell the property. And you'd want to work with your tax advisor on if we have any passive activity losses that we can help release and let go for future. We've accumulated over the years, but in the year of sale we can recognize that, and that's 2,000, or 35,000, whatever that cumulative amount of loss is. The year of the sales when we get to take that, and that's a tax benefit this year. Again, helping drive down today's tax. So a couple other things to think of, and again, I'm looking for low-hanging fruit opportunities here. We can dive in, and if I haven't lost everybody on the call, you can get awfully in the weeds on potential opportunities. I've said it a couple of times. I'll probably say it a few more times as I cough throughout the rest of the presentation. Work with your tax preparer, your CPA, on fleshing out what would be relevant to you guys. I mean, these are things that are available broadly, but again, it's not going to be applicable to every business. I do want to point out the employee retention credit, and it's an EIDL loan. And those are two federal opportunities that employee retention credit. I think we've had other seminars related to that retention credit, and what that is a benefit to employers that have employees that have paid payroll taxes. And based on certain calculations, you have to have a reduction in your overall income of your business to a certain percent from a quarter to a subsequent quarter, or the business has to be impacted by COVID. And so, we use a third party to make those determinations and do those calculations, but it has been quite beneficial to clients that have worked with them. And we're finding as many clients that didn't think that they would be eligible, and you say, oh gosh, we didn't have 20% reduction quarter over quarter. Well, but you've had business interruptions or business losses that are not economic. Your financials are strong, but we've had our supply chain management issues or whatnot. So we can get you more information on that, after the seminar. But there are groups out there that will calculate these retention credits, and it could be quite lucrative. So it's on a per employee basis, and it's I believe it's $5,000 per employee per quarter in 2021. So the laws have changed from 2020 to 2021. But that's an opportunity that I think every business owner ought to take a look at, because I think a lot of businesses are hard pressed, or churches and nonprofits. They're hard pressed to not be able to say that COVID has not been impactful to them. EIDL, that's a loan that a couple months ago, they changed the rules around that you are eligible up to $2 million worth of a loan. And those loans are a 30-year fixed at 3.25%. And you can use those loans to pay off other business expenses, operating expenses, or business expenses that when we acquire a business. Holy cow, I've lost my mind. Those expenses can then be paid as well. And so, if you're stuck in a higher note on a business purchase that you've had from several years ago, this might be a way to secure a lower rate loan federally that would be beneficial. There's other opportunities out there for taxpayers. And so those are things that I feel are pretty strong options that businesses should be looking at to hopefully help their business and help the business owners stabilize the overall spend for their business. Let's transition into on the personal side. So again, those previous topics were more business centric, and now we're going to focus on the personal. So again, that we've got that collision on the personal, the taxes, and the planning all kind of blending into one. This slide I feel is an important slide to a lot of business owners. So in the past, there's a 3.8% net investment income tax to entities. Passive income or net investment income, that interest, dividends, capital gains, things like that you would have investment income on, you'd get taxed another 3.8%. If married, filing joint, you're over $250,000, or filing single, $125,000. That's the current law. So you'd have another, and that was from the Obamacare or Obama administration era. That 3.8% was introduced, and that's current law. So below that, you don't have the extra surtax. Well, now what they're proposing, and I don't know where it's going. We've been looking at the similar information as everyone else is, but what's proposed is this 3.8% tax, net investment income tax. I don't know if they're keeping that label or it's just going to be an additional tax at 3.8%. That's going to they're going to raise the income threshold of the taxpayer. So the $250,000 that I was talking about in the first bullet point, now that $250,000 married filing joint would then get raised to $500,000. So it's weeding out some of those individuals that are making less money. But taxpayers that are making $500,000 of total income or more, or filing single at $400,000, those taxpayers then are eligible to any flow-through income that they're receiving from Subchapter S partnerships, LLCs, any other income that's flowing back to them. We talked about these flow-through entities. All of that income is going to be subject to the 3.8%. It's a big shift. That's a big shift. So instead of just certain investment income coming through and being taxable at the 3.8, it's going to be a wider spectrum that's taxable at the 3.8%. So it's going to, although yes, we're bumping up that income from 250 to 500,000, more income is going to be subject to the 3.8. So this might be an opportunity for those types of taxpayers. These are characteristics or things that are somewhat similar to your situation or projected situation in 2021. You might want to accelerate income. You might not want to accelerate those deductions. You might want to push forward more of that income in this year compared to subsequent years, because you might be able to sidestep that 3.8 or rounding up 4% tax. So something to think about. Again, not applicable to everybody, but it's something to work with the framework that has been presented to us currently, or the proposed framework. See what I'm talking about? Going down a river without a paddle. I think this is another opportunity, the long-term capital gains. So as you all are well aware of, currently capital gains, we sell some stock, long-term stock, it can be taxed between 0% and 20%. 0%, well, if you have total income below $83,000, I think that would be married filing joint. I'm not certain the threshold for individuals. It'll be lower than that. 83,000, well then the capital gains that make up that 83,000 is taxed at 0%. All right. So then if we move forward and we have income higher than that, then we've got tax at either 15% or 20% tax rate. But those taxpayers that have in total let's just say $80,000 or less, if they have capital gains, a strategy might be this year to sell those appreciated stocks and benefit from that 0% tax rate. A lot of times financial investment investors, investment advisors will work with you at the latter part of the year and harvest, they call it harvest losses. It's a way, it's a way for them to get rid of potential stocks they don't feel are going to be as strong going forward, and they want to clean things up and let's start the new year fresh and let's don't have those albatrosses around our neck. Hopefully nobody has those. I'm sure nobody has those. But if you did, they sometimes will clean those things up here at the end of the year. So if you fall into this category of, okay, about $80,000, okay, I'm going to have some capital gains. Yeah, I'm going to sell these appreciated stocks. Be working with your advisor if they go through and harvest losses to the tune of $15,000. Normally a taxpayer would say, oh, great, I got a capital loss I can take. It'd be great. Well, if you sold some stock, had some income, capital gain, and then we harvest these losses, it's hedging into your 0% tax rate. So it's gonna muck you up a little bit. So that would be something to be cognizant of. And if you're in that situation, stocks have done well over the last few years. We've seen our clients have done well in the market. We have the luxury to be able to see how the performance has been, and so we see a lot of capital gains. And so I don't doubt that that's going to be applicable here again this year. So be cognizant of the financial advisors that are working for you and with you, that if they're harvesting those losses at the end of the year, it might be detrimental to that 0%. Along the same theme of postponing income into 2022, generally speaking, as your income goes up, your deductible IRAs, those opportunities dissipate, child tax credits dissipate, education, being able to deduct education credits or deductible student loan interest, those things all the money goes up, your income goes up, those credits and opportunities go down. So that's big picture how that works. So as we're crossing through those thresholds, and they all don't have the same threshold, so you'd want to, again, work with your financial advisor on where you fall and all that, but I suspect many taxpayers have these opportunities. We'll be working with your trusted advisor to make certain, if we can, push more income into our 401k. If we make sure we maximize our 401k contributions. If you're a business owner and you have the flexibility of adjusting what your income is, or cranking up your expenses, or whatever we can do to hopefully defer some of that income, then if you're right on that cusp, goes back to my first qualified business income deduction point of if you're right in that cusp, we want to maximize that qualified business income deduction. Same thing here. We want to maximize the ability to contribute to an IRA or receive child tax credits or education credits. So those are things all what I'm looking to do is put pearls in your basket here to have you guys thinking through, oh yeah, we do have education. Oh yeah, I need to reach out to Casey, or I need to reach out to my financial advisor to see if I can be smart through that process and planning around that process. So what are things we should consider? So convert traditional IRAs potentially to Roth IRAs. As you guys are all well aware, traditional IRAs are tax deductible. I put $6,000 into an IRA this year. I get to deduct that contribution on my tax return. I don't have to pay tax on the $6,000. Well, the $6,000 over the years grow in an IRA, and someday, next week, next month, next decade, I want to pull out money from my IRA. Well, all of that $6,000 plus its growth is taxable. So that's the thought process on a traditional IRA. Roth IRAs are different. You take $6,000 out of your checking account, you write a check, and you contribute to a Roth IRA. There's income thresholds of if you're eligible to contribute to an IRA, a Roth IRA or not. But let's assume that you are eligible to contribute to an IRA. Well, then you can contribute to the IRA, and the growth there, you take it out next week, next month, next decade, when you're eligible to, then you can, the amount that you would draw down would be tax-free. So diabolically different strategies. I have clients ask me a lot, hey, oh gosh, we need to really convert traditional IRAs to Roth. And it might not be applicable to everybody. If we are looking to access those funds 3 years from now, we're going to pay tax on all of that accumulated growth and all of that income that we're flipping over from a traditional IRA to a Roth. We're going to pay tax on it. Well, that might not be applicable to all people, but that's something that you can do as tax rates overall are relatively low. I think next year the highest tax bracket is going to go from, they're proposing 37% to 39.5%, plus the 3.8s. Don't forget about those little surtaxes floating around out there. So it's going to go up, but we've had really bad tax rates, not terribly long ago. And so if you're looking to convert from a traditional IRA to a Roth, potentially now is the time to at least look at that again. It's not as easy as just, hey, I think I'll flip the switch and convert it. There's thresholds, there's limitations, tax calculations, what's the tax impact? So again, that's something to consider. I touched on this a little bit before. Defer year-end annual bonuses payments to you until next year, if you can. I mean, it's obviously, if you don't have to recognize the income this year, we know what we're dealing with from a tax side. Don't do that. That's an option to plan around. Well, the other side of that would be if you're really high income earners, you're going to you might be paying taxes at a higher tax bracket. We might want to pick it up at 37.5%, conversely to the 39.5% last year or next year. I mean, just depending on a couple months, it could be 2.5% higher. So something to consider. For itemized deductions, bunch those expenses to try to maximize the deduction. So if you think about on your personal tax return, you can take a standard deduction or itemized deductions. Well, we get capped on itemized deductions of property taxes and state and local taxes of $10,000. So let's just say we look at our sales tax and we look at our property taxes. It's more than $10,000, so $10,000. But you can deduct medical expenses over a threshold of your income. So medical expenses, charitable contributions, those are great opportunities to potentially not only pay some expenses for this year, but pay some expenses for next year and have those we're cash basis taxpayer. So when those payments are remitted, those would be deductions. And maybe if we can bunch up those expenses, then we can maximize the benefit this year. And then next year, we wouldn't have as many expenses. We're still going to have property tax. We're still going to have state and local or sales tax. But maybe we take the standard deduction next year. So it would not be doing the same routine every single year. You'd want to look at it and say, okay, hey, yeah, I do think we are church is going to have a building campaign. I'm going to be contributing a substantial amount. I'm going to do it in February. Why not do it in December? I don't think anybody would complain about that. And you might be able to take that deduction and stack them on top and have a maximize your deduction this year. And your deduction might be smaller next year and just take the standard deduction. Again, it's something to consider. Credit card payments. You can remit some payments, your taxes, property taxes for one, you can pay on a credit card or some other medical expenses. I would strongly suggest that when you have credit card payments, you pay those payments off. I mean, this is Dave Ramsey 101, I guess, but make sure you pay your credit card payments off. But if we charge that expense, it's deductible when we charge it in 2021. But if we don't make the payment until January of 2022, hey, you can defer. You keep a little bit more of that money in your pocket. Again, I don't think you're going to retire early on the savings there, but it's something to consider if Christmas is a high cash spend time and the holidays overall. So why not try to defer a little bit if we can and remit some payments on a credit card and then pay that off early in the year. Your required minimum distributions. So in the past, it was 70.5. The year you turned 70.5, you had to take a required minimum distribution by April of the next year. So that 70.5 now has moved to 72.5, I believe. So the year that we turn that 72.5, then we have to take it by April the next year. Well, I have a lot of clients when we're looking at this. They say, I don't really need to take it. I don't want to pick up the income this year. We'll just take it next year. Okay, well, so next year by April, we've got to take our required minimum distribution from the previous year. So the one that we deferred this year and we're taking it before next April, we got to take that one. And then we also have to take another one before the end of the year. So you're ramming forward next year. If this is the year that you have to take it, you're ramming forward in 2022 those several rounds of those RMDs. And so the required minimum distribution, the RMDs, that is calculated a lot of times by your financial advisor, your brokerage houses. They'll let you know what that number is. So be in touch with them now and just make certain you have a game plan of how you want that to be recognized. I think there's some benefit to not stacking up that income, especially if those required minimum distributions are larger amounts. That's going to push up your taxes and maybe get you up in that highest tax bracket or whatever the final verdict is on the tax legislation. The taxpayers older than that 70.5, the required minimum distribution, you're taking draws out of your IRA. What we see to be a very beneficial tactic would be take the charitable contributions, contribute to your charitable organizations. That's great that you're charitably minded. Contribute to those directly out of your IRA or your retirement account, I should say. So that is a great tool for you to then have that not be recognized as income. So if you've got to take a distribution out and it's a $50,000 distribution you're required to take out, and you want to give $30,000 to the church, for example, well, have your Fidelity or the brokerage house remit the $30,000 directly to the church or the nonprofit organization, and you don't have to recognize the full $50,000. The net impact to you would be $20,000 of taxable income. So it's a big way to help manage some of those tax brackets and impact Social Security, what's taxable to Social Security as well. So that's a good tool to implement there. I got to get my coughs in. My cough count is low. So a few takeaways here. I mentioned it before. Don't make extreme movements based on these speculative times. Several years ago, we had tax laws that sunset as of the end of the year, and the government didn't finally make final proposals and final determinations to well into the subsequent year tax year. So, I mean, literally flying blind there. Hopefully it doesn't get to that. Hopefully we can get a decision here made and final determinations and know at least what tax laws we're working with going forward. But overall, don't make extreme movements based on speculative information. I think it's going to go to the second bullet point. I think the tax impact is going to be substantial to some, but it's not probably going to be as dramatic to all taxpayers as we're led to believe. It sells newspapers, but let's just wait and see. We kind of take a measured approach. We're not gonna make too aggressive of actions until we know truly what that tax law is looking like or the final approach. My third bullet point is the golf swing approach. I'm a golfer. I love to play golf, and in golf, a really good golf swing is a smooth approach. A smooth backswing. It looks effortless and come through the ball, and it looks like you know what you're doing. And what do you know? The ball just goes flying off your golf club. Maybe it's a way for me to pacify taxes with golf, but I think of tax planning a similar way. Let's don't be herky jerky. Let's don't be aggressive. Let's be calculating what we do. Let's take a measured approach. Let's don't overreact. Let's be nice and smooth and take that golf swing approach, and that's usually makes for a great outcome in the subsequent years. Finally, make an investment in a tax advisor, financial advisor, individuals that can help you. Those individuals, myself included, are specialists in what we do. We don't have every answer, but we have access to obtain a lot of information. And so make an investment on the front end, so then there's minimized frustration on the back end. If we've missed an opportunity to maximize something or take a deduction, or gosh, the end of the year came and went, we're so busy with all of our other activities, we've missed a planning opportunity. Make an investment now in the next month to have at least a quick phone call, and if it requires a meeting or requires further diving, a deeper dive, so be it. But I think the end result is going to be a better final product for you. So here's my contact information. My phone number, 817-664-3000, email, web address there, and feel free to give me a shout. I'd be more than happy to answer any questions. If I haven't totally bored everybody with the topic, I'd be more than happy to answer any questions that somebody or anybody might have. If I don't have an answer to you, I'll take notes, and I can circle back with you shortly after the seminar here. So I'd be more than happy to answer any questions if time allows me, but at this point, I'll pass it back over to you.
Okay, thanks, Casey. And thank you guys for the hold music. I didn't realize that you weren't hearing any of my housekeeping items, so I do apologize for that start. And Casey is available for questions, and we have a small audience today, so in just a few minutes, I will unmute everybody. And so if anybody has anything they want to ask and he can offer some guidance, he's here to do that. I think everybody on the call is familiar with either PSK or Payroll Partners, but just in case you're not, thank you so much for being with us today. I'm with Payroll Partners. My name is Mia Walker. We offer payroll and tax services, but we also have a great timekeeping system that offers a mobile app and GPS tracking. We also offer electronic onboarding, benefits management, and applicant tracking through a great human resources management platform. And some ancillary services that we do get asked about that we may not specifically provide but have referral partners are things like background screenings, workman's comp pay as you go, employee loan programs, and even OSHA law posters and things like that. So just in case you and I have not spoken, I do look forward to it if there's anything we can assist you with. We've been in business since 1996, based here in Arlington, focused on nonprofit, faith-based, and small businesses in the area is really who we work with. So I am just going to allow everyone a few minutes to see if there's anybody who has any questions. Everybody should be unmuted. If not, you may have to unmute yourself because everybody is unmuted on my side. And I do appreciate everybody who's on the call and who took time to be here with us today.
And me, it might be something to where sometimes you don't know what you don't know. And so I would advise if some of these things, maybe you thought, I think I saw that on a tax return, or if nothing more than maybe pick up the phone, call your CPA, call your financial advisor, and just what today is a starting point, is to try to nudge you forward into being proactive instead of totally reactionary as the new year approaches, and so I suspect that might be where we are, is that we just need a chance to consume it. And you have all my contact information there. If somebody needs me, feel free to give me a shout, and I can just give you feedback on pick up the phone, give me a call.
Absolutely. Thank you so much, Casey. We appreciate everybody's time. Here's the contact information. You should receive a recording and a copy of the slides as well after the presentation. And we'll talk to everybody again after the new year. Thank you. Thank you, Casey.
Great. Thanks so much. Take care.
Thanks. Bye.